Ever spend hours drawing the perfect support zone, only to watch the market take off without ever touching it? Traditional support and resistance tools often miss these setups because they assume the market behaves like a bouncing ball trapped between two perfectly flat floors. In reality, prices travel in a zigzag. Even in a strong upward climb, the market takes brief, necessary steps downward to gather energy before pushing higher. If you can map the anatomy of those tiny downward steps, you start to see the logic behind how a trend actually builds its momentum. Think of the market like a mountain climber ascending a steep peak. This line graph mimics our mountain climber. The path doesn't go straight up. It climbs, drops down slightly to set up a secure base camp, and then launches a fresh push past the previous highest peak. During an upward climb, this resting phase is where the flow of buying and selling orders resets for the next move. If the market is heading downward, the mechanics flip. The climber is descending, and those temporary upward resting phases become the new areas of interest. By identifying these temporary base camps, we can map out the specific pocket of space the price will likely return to before it continues its journey. We can't just draw a box around any random dip on the chart and hope for a bounce. To find a valid base camp, we look for three specific structural signs. First, price must surge past its previous peak, proving its strength. Second, isolate the final downward leg before that breakthrough. Third, the area must be fresh. We draw a box extending right, an untouched, valid place to watch. When you have a fresh, final pullback acting as the direct launchpad for a new high, you have located a high-probability zone. Sometimes the downward leg is massive. Drawing a box around a giant dip makes your safety net too far away to enter a trade safely. To manage this, we divide the large zone in the middle. The top half is a premium price, where drops are likely, but the lower half is a deep discount, offering a much safer entry point for a buyer. Slicing the zone in half forces you to stay disciplined, ensuring you only commit when the market offers a better deal on the overall trend. Let's take these concepts and apply them to a standard financial chart moving in an uptrend. We start by scanning the peaks until we spot the moment the price clears a previous high point. This chart shows that breakthrough. We draw a box around the final sequence of downward red candles right before the push. We bisect it with our midline, highlighting the bottom half. Watch as new candles retreat downward, sinking past the midline into our target zone. Watching the price enter this discount area is the first step, but it is not an automatic signal to buy. This is just the staging area where we prepare for a final trigger. We never buy blindly just because the price hit our box. We wait for the market to prove it is ready to turn back up. This final diagram shows what we're looking for. Inside our zone, a strong upward candle forms. This proves buyers are stepping back in, and the price begins to move sharply higher. Remember the 4 steps. Wait for the peak to clear. Find the last pullback, mark the halfway point for a discount, and wait for that final confirmation. By treating these temporary dips as structural base camps, you can start to see where buyers are likely to step back in, turning the market's zigzags into a clear roadmap.